Do you want to know how to invest tax-free in almost anything you want? Invest tax-free in things such as real estate, businesses, notes, stocks, and so on? Hello, I'm Matt McFarland. I'm the Managing Director at Keystone CPA. I'm joined here by my partner, Amanda.
Hi everyone, I'm Amanda Hahn and I'm also a director with Keystone CPA. Welcome and thank you for joining us on this educational video series. In this segment of our video series, we are going to demystify the traditional route to retirement and show you an accelerated road to wealth creation through self-directing.
Specifically today, we're going to touch on what exactly is self-directed investing and how does it benefit you. Secondly, we're going to touch on how to reduce your current tax bill using retirement planning strategies. And lastly, we're going to touch on a planning opportunity for an enormous tax break that's coming soon.
All right, so first let's take a step back and talk about why you should care about taxes. Well, studies have shown that the number one erosion of wealth in the United States is taxes. And actually, a recent study performed by some economists at Boston University showed that the average American loses anywhere between 40 to 50% of their income in taxes.
Wow.
Now, these taxes include federal and state income taxes, payroll taxes, property taxes, and sales tax, just to name a few. So for us as taxpayers, the only way to legally reduce our tax liability is through tax planning. So today we're going to talk about tax strategies that will allow you to accelerate your wealth creation. Let's give a very simplistic example. So for the average American, every $100 you make, you'll probably lose around $40 in taxes. And then the $60 left over is invested. Well, how much faster do you think you can accumulate your wealth if you make $100 and then invest that entire $100 to grow your wealth without having to pay taxes first? This is the power of tax planning. And today we're going to talk specifically about tax planning using self-directed retirement accounts.
So what are self-directed retirement accounts? Well, self-directed retirement accounts, which include common vehicles such as traditional IRAs, Roth IRAs, or solo 401ks, allow you to invest in alternative investments with your retirement money. By alternative investments, we typically mean investing in things that are outside of the traditional stocks, bonds, and mutual funds that most advisors will tell you that you can invest in.
Yeah, so what can you invest with self-directed retirement accounts? Well, it's pretty much limitless. I mean, you can invest in businesses, real estate, timber, almost basically anything that your mind can come up with, except for life insurance and collectibles. So if you're an expert in, let's say, a specific type of business or real estate investing, it may make sense for you to invest in those areas because you may do better with those investments based on your expertise. Now, we already talked about the reason that we always want to invest in a tax-efficient manner, and that is to eliminate the tax drag and then grow our wealth in an accelerated manner. But imagine the power of your wealth growth when you can combine the tax benefits of IRAs with the ability to invest in what you know best with that competitive edge. This is the power of synergy when you combine the two great ideas together.
Now, let me ask you a question. How would you like to use pre-tax money to invest in real estate or businesses and not pay taxes when you receive your income? So as an investor looking for a place to put your money, would you be interested in hearing about an idea like this? I bet you would. We've actually implemented a strategy for our clients that allows investors to invest money from their individual retirement accounts by using pre-tax money, so money which has not been taxed yet, and receive a portion of their earnings tax-free down the road when they receive their return on investment.
Yeah, so if you're a high net worth or high income investor, this strategy alone could mean additional return on your investment of up to 40% just in tax savings. So if you're looking to exponentially increase your return on investment, make sure you work with a strategic team of advisors to help you identify investment opportunities where this tax break exists.
Now, one of the greatest areas of opportunities in tax planning for businesses in any industry is the tax benefits of using retirement plans. Retirement plans set up by the business owners can reduce the company's tax liability, but also can reduce the business owner's personal tax liability. And there are big opportunities for tax savings here. There are plans available where you could stock away close to $50,000 a year for retirement.
And the best part of this is that you can set up these plans so that most, if not all, of the contributions are tax deductible. And this results in huge tax savings.
Yeah, so let's go over a quick example, one that's very similar to which we helped a client with. Let's say your business makes $250,000 per year and your average tax rate is 40%. Then, by having the ability to contribute, say, $50,000 a year to your retirement account, this could save you $20,000 a year in tax savings alone. Think about that for a moment. Put $50,000 into your retirement and get an immediate $20,000 in tax savings back as a refund. And then, when you consider the compounding effect of having an extra $50,000 per year in your retirement, growing tax deferred, your wealth building has just exponentially increased, right? So this beautiful strategy allows you to decrease your current tax liability and allows for deferred investment growth. And that's the best of both worlds for your wealth planning.
Yeah. Well, let's move on and talk about an enormous opportunity that we now face to take advantage of. I'm guessing that most of you don't know what TIPRA stands for, and that's okay. It's just an acronym for a relatively new tax law passed a few years ago. In essence, one of the major opportunities provided by this tax act relates to investing with your traditional and Roth IRAs. Now, before the new act, an individual could only convert their traditional IRA to a Roth IRA if their adjusted gross income for any given year was below $100,000. But the new rules will allow taxpayers to